So in terms of sizing positions, there's always that tension between putting capital, a lot of capital behind your best ideas, concentrating into a few things that you really have conviction in versus having diversity, which gives you more stability. There's risks in both sides, obviously. The risk of concentrating too much in one idea is that you're wrong, and it can have a disproportionate effect on your performance when you're wrong. And then the other risk of over-diversifying is spreading yourself too thin. It's what you can understand and know. The more things you look at, obviously, the more superficial your knowledge becomes. We found over time that for us, and it's going to be different for different investors, that having about half of our capital in our top 10 ideas is where we feel most comfortable, with our top idea being 5 to 7%, and then about half of it, half the portfolio in the top 10. And then that leaves us room in the bottom tail of ideas to do things like the Ben Graham basket, where they're smaller ideas with maybe more binary outcomes or more unpredictable types of outcomes, the higher risk, higher reward ideas. I think the other thing, and this is an idea from Charlie Munger, the concept of having a pre-flight checklist where you look for red flags, things that are associated with prior mistakes, is a big part of our process too. We have this thing we call the failure index, which is 40 different red flags that I don't do this myself because I want somebody else on our team to do it and to enforce it on me. But every time we're about to put a new idea into the portfolio, this person on our team goes through and does a checklist and goes through all 40 of these items. And if 5 or more of those items are present, then he comes back to me and says, you can't do this. And then we have a big discussion, and more likely than not, it's not going into the portfolio. And so where do we get this list from? It was things that we observed over time we made mistakes on and made errors on. And it actually goes back to my time working in a large money management firm where I did a project with a couple of other people to look around the firm. We manage a lot of mutual fund portfolios at this firm, and we looked in the aftermath of the tech crash at all these portfolios that had huge losses, and we did a project to analyze what happened in these portfolios. Was there any learning from it? And we found that in most of the cases where a portfolio blew up and did very poorly, that it was a very small number of ideas that we called torpedoes that ruined these portfolios. Maybe 2 or 3 different investments that were made in large size that had catastrophic declines. And so we asked the next question, were there common characteristics among these torpedoes across portfolios, different managers, different portfolios, different styles? And we hypothesized a list of things. We got everybody's input and went through and tested them and looked at were these red flags present and could have been known before these investments were made or not. And we found a shorter list of those that seemed to have a correlation to these blow-ups. And it's evolved over the years, and we've learned from it over the years, and I feel very strongly about applying that list. And it has saved us from far more losers than it's kept us from participating in winners. It's a very nice filtering ratio.